Private equity funds are behind the biggest business buyouts, often worth billions of dollars. They've been around for decades, but they're still faced with a perception problem.
And I think part of the problem with that is it was sort of a perception created in the early days of private equity in the late 80s, particularly in the US. You hear all the Wall Street stories, barbarians at the gate and all this type of thing.
International private equity funds are involved in the ownership of many big New Zealand businesses, including the All Blacks, Bluebridge Ferries, Waste Management, MediaWorks, and the retirement village company MetLife Care, which was a $1.3 billion deal in 2020. Pacific Equity Partners is easily the most prominent player in private equity down under, buying and selling businesses as big as Hoyt Cinemas, Tegel, the chicken company,
Tegel guaranteed fresh chicken,
Griffin's, the maker of biscuits, and Peter's Ice Cream, Australia's tip-top equivalent. According to Deloitte, there were 149 buyouts across Australia and New Zealand last year, worth $9.4 billion in total. That fell from the previous year's 205 deals, worth $18 billion. Although that year included Blackstone's $6.6 billion acquisition of Crown Resorts. Blackstone is one of the global PE giants, alongside KKR, Apollo, and the Carlyle Group. They all want to clip the ticket on the revenues of successful private companies that are not listed on public stock exchanges. Historically, private equity funds have outperformed the S&P 500, although the datasets often differ, so it's kind of like comparing apples with oranges. There is a trade-off too. Private equity funds require investors to lock away their funds for 5 to 10 years, making it an illiquid investment option. But firms like PEP are trying to increase access to it, with new funds being pitched to retail investors as we speak. That's what its managing director Cameron Blanks was doing in New Zealand this month, trying to put a face to private equity. Cameron, good to see you. Thanks so much for coming in.
Yeah, well, thank you very much for inviting me, Madison.
Anytime. I want to talk about private equity and PEP's role in it, but just on the macro about what is private equity, how it's perceived. Can you describe to me where you believe the private equity market globally and also in Australia and New Zealand, where it's at currently?
Yeah, well, I think if you go back to the origins of private equity, it was all started in the mid-80s in the US, organised private equity where people would raise funds from large institutional clients. So it evolved out of there. We're now 40 years into that journey if you think about the evolutions of the private markets. So it's a large asset class today, with about 12.5 trillion in the global private markets if you think at a macro level, and some very large managers of money globally. So that's the sort of the global context. Returns have been very good. It's absolutely been outperforming public markets and outgrowing public markets. But obviously when you come down to the individual countries and regions, you get some nuance in that story. So I can get into a bit more of that context if that would be helpful as well.
How about you give us some anecdotal evidence of what you've seen at PEP in the Australia and New Zealand markets? How many deals have you done in, say, the past year, and compare that to, say, the past decade?
Yeah, so look, we've been in this market, the Australian and New Zealand market. Our very first deal was in New Zealand. It was a corporate carve out from the parent Apple board of a business called Frucor in 1998. So 26 years later, we're seeing a very active market still for deals. Typically we look at about 100 to 120 deals a year, and we go through a filtering process of assessing those. Like a lot of that 120, they're not necessarily for us, and we know that reasonably soon. So we end up with a core opportunity set of maybe 20, 25 opportunities that we're looking at every year, and we'll probably do 2 or 3 a year. And that's really been the same cadence all the way through. For us, markets go up and down, but a lot of it's about the situations that we're investing in. There are periods, obviously, where it's a little slower than others. I think 2022, late 22 and 23 were particularly slow given the rise in interest rates, and it was very hard for buyers and sellers to come to a meeting of the minds around value. But generally, that's the cadence of deal flow that we do see and have seen for a long time.
Do you feel like we're out of that now? The fact that this economic cycle is finishing, that interest rates are set to lower, albeit at a sort of neutrally higher level. Are you seeing a bit more opportunity in terms of people looking to sell to you, but also easier exits out of businesses that you've already bought?
I think that's exactly right. It's just time for buyers and sellers to come to an agreement around price is it does take time, and I think when you see big changes in interest rates, it's harder for people to have that perception around what's fair value. So we're definitely seeing more activity and more preparation for activity going on now. So I would say, restoring to normal is on its way.
Private equity players are often, I've heard, referred to as vampires. They go into businesses and they suck the blood out of them. They cut costs, they typically cut staff. Then you sell the business for a gain because you've made efficiencies within it. Is that true? Is that what you do, Cameron?
Well, I think we certainly don't think that's a good characterisation of private equity, but we do hear that all the time, and I think part of the problem with that is it was sort of a perception created in the early days of private equity in the late 80s, particularly in the US. You hear all the Wall Street stories, barbarians at the gate and all this type of thing. So it is a caricature of our industry, unfortunately, and we do have to answer those questions more often than we'd like to. But the reality is, for a private equity firm to have a sustainable business, we need to be buying businesses and making them better, and then having a very clear growth story for the next buyer. Because if you're just dressing things up for sale, asset stripping, not adding value, and not creating sustainable profit growth in the businesses that you're buying, you don't have a very sustainable business model, and you will go out of business. So the high quality private equity firms that have been around for a long time have understood that they truly need to buy businesses with a view to adding value and building a better business for the next owners to take on the next journey.
But fair to say, even decades later, private equity, and it seems everyone is still painted with the same brush, fairly or not, there is a perception problem there, you'd say.
Look, I think perception is reality sometimes, as people say, but I think if you really dig into the reality of the way that private equity firms have been around a long time, go about their business, I think reality is quite different to that perception.
Have you heard of Charlie Munger's horse analogy when it comes to private equity?
No, I have not.
Do you want me to share it with you?
Sure.
He referred to it as a farmer who had a great horse but often misbehaved, had some issues. So he went to the vet and said, I don't know what to do with this horse. It's a great horse, but every now and then it just has some behavioural issues. The vet says, I have the easy answer for you. When it behaves well, sell it. He says that's what private equity does with businesses. What do you make of that?
Well, I mean, I think you can have a lot of interesting stories. The way that we think about it is if you're consistently selling businesses that don't perform for the next owner, then you will get a reputation for not selling businesses that have sustainable profits in them, and therefore you will not have a sustainable business. So, our view is that as we're building these businesses and thinking about how to build them in a sustainable way, we need to make sure that the next buyers have good experiences, so we become known as a good seller of businesses as well, so we have a sustainable business. So interesting story, good anecdote, but I think the private equity firms that have been around for a long time understand the needs to keep building sustainable businesses would be what I would say to that.
And when you're pitching this to investors, most private equity firms typically rely on their IRR, their internal rate of return. Yours is 28% since inception, I believe. Yes, that's still correct? Cool. Yeah. Warren Buffett, to use a similar person who does not particularly like private equity firms, he says that is dishonest to use the IRR because Your assets are never marked to market in a down cycle, like public markets are, so they always look good.
Yeah.
Can you explain to me the formula of your internal rate of return, what goes into it, and is it really a fair measure?
Well, the 28% that you just quoted is the average delivered IRR in a fund. So there is no marks or anything like that. These are funds that have been raised, deployed, and then returned to their investors. So that number doesn't include any marks at all. So we have delivered that return to investors, and it is a honest, sustained number over a long period of time. So again, a lot of characterisations, and people say a lot of things, but that's certainly not our experience.
PEP likes large late-stage buyouts. What is that? Can you give me an example of one of those that was executed perfectly by PEP?
Yes, so look, there's obviously a large part of the private markets, that people think about when they think about private equity is often venture capital or growth capital for, companies that are privately held by individuals or a group of individuals that are looking for capital to grow. That's certainly not what we do at PEP. We are really focused on what we call late stage buyouts. So these are big established businesses that have market leading positions that have sort of lost their way either on the public markets or as divisions of big multinational companies or the like, that we can carve out or take private, give a new lease of life, typically with new management, and have them go and execute a very clear strategy of doing 2 or 3 things differently than they've done in the past, to work towards doubling the profits of those businesses in a sustainable way, as we've spoken about. So that's the style of private equity that we do. But it's very important, when people are trying to understand their industry, to understand what stage of a company's life that they invest in, and how do they go about generating returns for their investors, because not every private equity firm is doing the same thing or participating in the same part of the cycle of the industry.
2 or 3 things to double profits. I mean, tell us what they are, because everyone would do them if they could, wouldn't they? I mean, that seems like easy.
A really easy example to explain is Tegel chickens, which is a great New Zealand brand. Now, this is a deal from a long time ago. We've long since gone from Tegel chickens, and we owned the business for 2 or 3 years. But this was a corporate carve out from Heinz. So, New Zealanders may or may not remember, but for many years, Tegel was owned by Heinz. It was the only chicken business that they owned globally, and the way that the incentives worked within the broader Heinz system was really US-centric, where every % of market share in the US is really important to profitability of Heinz. So if you think about, tomato sauce and all of those things that Heinz are known for, their whole management incentive structure was around market share. So what had happened down here in New Zealand on their only chicken business globally is the management team was incentive on market share. So they kept on spending capital on growing out the capacity of chickens that they could produce to put into the market. Well, we all know what happens when you produce a lot of volume. Well, price goes down. Supply and demand. And so the management team of Tegel were getting their bonuses because they were increasing their market share, but their profitability was going down. But it didn't matter because you had the wrong incentives in place and a far-flung business in the broader Heinz network. So a big part of the thesis around that acquisition, as an example, was to stop doing that, to buy the business, to stop increasing volume, and to ultimately realise a better price by value adding in the chicken. So going up the supply chain, so you were then delivering a packaged, smoked chicken or whatever the product, the value add was, and invest in that rather than just continuing to pump chicken into the market.
How did you find out about this? How did you find out about the effectively ill-advised incentive structures and how it was impacting their margin? Do you have people come to you and tell you this stuff?
Yes, yeah. I mean, look, we've been in the market for a very long time. We're one of the biggest pools of capital in the market. I think we were actually tracking the Heinz sort of story for about 7 years before we executed that deal. We would fly, to the US and talk to head office about one day would they sell their, subsidiaries down in this part of the world. What the catalyst for that deal was there was, if you remember, it was around about the time that there was an avian bird flu up in Hong Kong, which started to spook the world about losing birds and obviously chickens through the avian bird crisis.
No one really wanted to eat chicken then.
And also the companies were very worried about their flocks getting wiped out and the like. So we did a big study about this as part of our due diligence of whether this was a good business to buy. And it turns out that there's no migratory birds that come into New Zealand. You have a very biosecure framework in New Zealand. So the chance of avian bird flu coming into New Zealand was very low. Yet you had a business in Heinz that was headquartered in North America that was very worried about this. So they were actually willing to sell their chicken business, their only chicken business, in the middle of an avian bird flu at a relatively attractive price. So that's a classic example of what happens within these large global organisations where decision making is made around non-core subsidiaries that are relatively irrelevant in a relatively irrational manner. And it's a great example of the types of opportunities that we focus on within PEP.
So you go pretty deep on your due diligence.
Absolutely. I mean, it's everything. It's about asset. Ultimately, we only do three things. We decide what to buy, and that's through very deep due diligence on the asset and the market dynamics and the position of the business in the market. Who to run it, the CEO of that business was very important. There's a guy called Ron Vella, a great New Zealander. Ronnie's a great guy, and we loved investing behind Ronnie, supporting him in executing that strategy. And then ultimately we get to decide when to sell an asset. Unlike the listed markets, you're always for sale. With a private asset, you can decide when to sell the business. So it's those three things that we really do: what to buy, who to run it, and when to sell it. And that's fundamentally the job of a private equity executive.
Specifically on what to buy, we will talk more about exits and that strategy in a minute, but it seems like PEP has very much liked FMCG. You had chickens here, you had Chicky here, and Bicky across the ditch with Griffin's Biscuits.
Yeah.
Is that preferred still, or are you looking at other things now?
Look, I think what we don't like is businesses with big uncontrollable risks in them that we can't control from a management perspective. So it's more about finding businesses that don't have that characteristic. So more recently we've been investing in education, in healthcare, FMCG obviously, or business services, or things where we feel like it's actually management execution that delivers the profit growth as opposed to trying to ride some new trend. So PEP's not chasing AI, although we're very interested in AI and what it can do for our portfolio companies. We're not looking for AI investment. So, and we never have been a trend-based investor. It's about finding good, stable businesses with clear strategies that can double the profits of those businesses. It's really that simple.
On the exit side, on the way out, have you ever been impacted by a liquidity event where you've either been forced to revalue something lower or forced to sell it?
Well, typically we've always sold businesses at an average of about 30% premium to our valuations, and again, it's very important on the valuation side to differentiate from venture capital and growth capital compared to late stage buyout. The motivations for venture capital and growth capital is to ride up very high valuations because they're doing rounds of funding where when you need new funding, it comes in at that valuation. Very different dynamic in late stage private equity where we focus, where there isn't rounds of funding. We buy 100% of the business and then we own it and then we sell it when we choose, and at that point in time we get a performance fee. We don't get any sort of compensation based on the valuations on the way through, and we don't care what those valuations are. We never used to even do valuations. We just hold the businesses at cost until we sold them.
Well, then how would you know to sell it if you didn't know what value you were going to get? Would you value it around the time of potential sale?
Well, obviously, we don't value the assets. The market values the asset. The buyers value the asset.
But it's not in market, it's private. It's
privately held. Whatever we think the value is irrelevant. It's what the buyers think is the value. So our valuations are totally irrelevant. We don't even think about them. The only reason we do them is because we have pension fund investors that have members who are coming in and out of their pension funds, and they need a valuation. So they have asked us to do valuations for them. We take them very seriously because it's our fiduciary responsibility, but we actually want to have those valuations at a level that we know we can find buyers to pay more than that. So typically we're exiting at about 30% premium to our current valuations. It's really important. That's the dynamic in late stage private equity, different dynamic in venture capital and growth capital. And that's the area where people go, all the private equity valuations are rubbish. They're true in the venture capital and growth space, not true in late stage buyout. And this is where all this nuance about our industry, it's really important to do your research and understand how our industry works.
I know you just said you don't care about valuations, but what do valuations look like at the moment? They had a pretty incredible wave through the cheap money era. I imagine now valuation of private businesses is looking a bit tough as their margins struggle.
Well, I mean, again, we're dealing in late stage private equity with big, boring businesses. So, tissue businesses, ice cream businesses, hospitals, education businesses. So we're not in the sort of very highly valued sort of tech type world. So the valuations, when you look at the multiples, you may have gone from an average of 12 times profits to 10 times profits, but actually when you look at the sort of compression of multiples, it's not anywhere near as much as you think when you think in the industrial sort of more traditional parts of the markets. And so, those valuations, obviously, the way that we think about them, are applied to the profits that we're making in the businesses. So if we're doubling the profits of the businesses, whether the valuations have gone from 12 to 10 or 12 to 11, the value of the businesses have still grown dramatically. Just because the multiples come down by a turn doesn't really make that much difference.
So what are you doing in New Zealand? Are you looking for businesses to buy? Are you asking investors for funds?
All of the above, and we're always doing all of the above. We're here in New Zealand a lot. From our perspective, even though we have one office in Sydney, as I referenced before, our very first deal was here in New Zealand, and then over the 26 years that we've been in existence, we've probably deployed about a third of our capital in New Zealand. So it's a very active market for us. And we continue to invest very heavily in New Zealand. We love it as a investment destination. We love it as a country, and we are expanding our ability to raise capital from New Zealand individuals as well, which we're really excited about.
What's a New Zealand business you would love to buy?
Oh, that's a interesting
No, it's not.
question.
You'd have a wish list, wouldn't you?
Well, we do. I mean, I think we're situational investors. So what we learnt early on in our existence is it's like, walking down a road of beautiful homes and saying, I'd love to own that one, but it's not for sale because the person living in the home doesn't want to sell it. And that's what we've learnt about, private equity investing is the vendor wants to actually sell. So, to actually go and search around with a list, in our minds is a bit of a waste of time. We'd much prefer to make sure that we know what a vendor is thinking before we really start to work on an opportunity.
Everyone's willing to sell at the right price, though, aren't they?
Of course they are, but are you willing to buy at that price? So this is this whole dynamic that we were talking about before, which is about buyers and sellers having a common view on value, and ultimately a vendor does need to decide to sell before we can buy. So we don't stylistically run around with lists or thematic things. Where it's actually situational investors.
Are you finding that when these vendors do come to you and they are willing to sell their business and allow you to buy
Yes.
it, are you having to factor in more features to deals now, like promises to not cut staff or to move manufacturing or more executive earnouts, for example?
Look, it's been, I think if you think about the context that private equity is investing into, it's been reasonably consistent. You know, we're a private buyer of businesses, and the vendors typically are trying to maximise the price that they can sell the asset. If they're selling 100% of the asset, then it's really all about price. And so, you know, we're not running around and trying to buy things cheaply. We're happy to pay full and fair prices for good businesses that we think we can make, to build into a better business. So generally, no. There are circumstances where a vendor will actually look to roll their equity with you and continue the ownership. So at that point in time, the dialogue actually goes to what can we do to add value to that business, and how can that vendor come along on the next leg of the journey for us. So that's more those sorts of deals, opportunities that come with a few other conditions along the way, but typically they're asking us to come in and add value to those businesses. So it's a mutual dialogue of getting on the same page about the strategic plan for the next leg of the journey. Favourite
business you've bought and sold out of, and
Yeah,
how much money did you make on it?
Yeah, look, my personal favourite is a business called IntelliHub. It's a business we actually still own, but we've sold to what we call as a single asset continuation fund, which we manage as well.
It's yours, right?
Well,
Yeah, it's just moving it into a longer term fund.
Although we sold 50% of it to Brookfield. So there was absolutely a new investor that came in and valued the business. And it's a terrific business. So it was a combination of a corporate carve out from Origin Energy and a corporate carve out from Mercury Energy here of their smart metering division. It's a business that particularly in Australia is going through a rapid period of growth as Australia catches up to New Zealand with the deployment of their smart meters. And so this business is incredibly well positioned to be right at the centre of the energy transition in Australia, and is a very big business with a huge amount of opportunity. It's an absolute delight to have monetised the first leg of the journey, through selling 50% to Brookfield, but enjoying the next leg of the journey with Brookfield to again double the profits and continue that growth.
How much dry powder are you sitting on currently, ready to allocate in
Yeah,
Australia
so we've
and New
fully
Zealand?
deployed our sixth private equity fund. We're currently in the process of raising a $3 billion Fund 7. That raise is going very well. It'll be completed by the end of the year. And then we will.
And then you're ready to spend.
We'll spend, although we already have one deal that we've already done and warehoused to go into. There's already a deal in the fund. We are deploying. We continue to deploy. As I said, we end up doing 2 to 3 deals each year.
If I bring you a deal of a business that wants to sell, do I get a cut, Cam?
Oh,
Is that how it works?
absolutely.
I'm not buying it.
Yeah. We'll just have to discuss
We'll
how
have to
much.
agree on price.
Yeah,
exactly.
That's right. Yeah.
Thank you so much for coming in. Lovely to chat to you as always.
Yeah, wonderful. Thank you very much, Madison.
Thanks for watching Markets with Madison. If you enjoyed this interview, please hit the like and subscribe buttons below. I do all of the research for these episodes myself, so your support means a lot. I always love to hear your feedback and ideas, so please drop any thoughts in the comments below. Now go put your money to work.